This morning I will talk to you about the cash-generating machine that is Ramelius, admittedly benefiting from an all-time high gold price environment, but we're doing our part in terms of managing our high-grade operations efficiently to be one of the lowest cost producers in the mid-tier gold space. Standard disclaimers, noting our forward-looking statements. If I may start with our corporate overview, focusing on the top left, current market cap about 2.2 billion. We have over 350 million in cash and gold, and that is after our recent acquisition of 18.3% of Spartan Resources, which forms the bulk of our listed investments, which initially were valued at 186 million, but obviously worth well over 200 million today. We have no drawn debt, though we have recently upsized our revolving facility with 5 banks over a 4-year term to 175 million, giving the company added financial flexibility should we need it. Our balance sheet, already in excellent shape, is only expected to strengthen through FY25. On the top right, we recently announced record gold production of 293,000 ounces for FY24 at an all-in sustaining cost of 1583 Aussie. And FY25 guidance is in a similar ballpark, but I'll come to the details on that at the end. Our project locations, for those who aren't aware, we have 2 production centres, Mount Magnet with a plus 10-year mine plan, and Edna May, which will be winding down in Q3 of FY25. We have 1 development project east of Kalgoorlie, the 3.1 million ounce Rebecca Roe project. As I alluded to earlier, we have made a strategic investment of a bit over 18% in Spartan Resources, whose primary project is at Dalgaranga, some 65 kilometres northwest of Mount Magnet. I won't say or expand any further on Dalgaranga, as I suspect you'll hear more about that project very shortly. Suffice to say, our BD team are continually analysing opportunities, and at Dalgaranga we liked what we saw. In saying that, we were pleased that the recent mineral resource estimate was in line with our internal expectations, and we are happy to add this position to our exciting organic growth opportunities. We will continue to take a disciplined, value-based approach to growth, be it organic or inorganic. Now, as I mentioned at the outset, Ramelius is currently generating significant cash flows. And we think this is really important in this high gold price environment and can often get lost in the noise of production growth, exploration results, ESG credentials, cost initiatives, etc. 315 million free cash flow for FY24, and we'll see how that compares on an absolute basis shortly, but I'm confident is sector leading on a per ounce basis. This not only leads to a great balance sheet, but allows you the flexibility to seize opportunities when they arise, and also potentially will provide shareholder returns not normally associated with the mid-tier gold producers. Now, last year we predicted that we would end the financial year with cash and gold around 400 million. Well, if we add back the 87 million spent on Spartan at the very end of June, we would have effectively ended the year at 530 million. A pretty significant outperformance for the year. Now, given the time slot, I think I can get away with 1 peer comparison slide without offending too many people. This chart shows that Ramelius competes very well on a total cash flow basis for FY24, with much larger peers with much larger production profiles. I think it provides an interesting perspective on the myriad of numbers that the market has to deal with all at the same time. Now, the reason we're generating these stellar cash flows is because we are expanding our margins, not only relying on high gold price, but also being in the unique situation where we are reducing our all-in sustaining costs, as this chart shows. The yellow line in the chart is realised gold price. We've used actuals up to FY24, and for FY25 we've used a spot price of 3,500, combined with our forward sales book. The green line is all-in sustaining costs, again actuals up to FY24 and the midpoint of guidance for FY25. Now, we've increased our margins in FY24 and 25 over previous forecasts, and whilst we do have a portion of production hedged, I would argue that the margin is the key point here, regardless of whether you are hedged or not. Now let's have a look at our flagship Mount Magnet operations. This is the Mount Magnet mine plan as released earlier in the year. Production is stronger at the front end, with both Penny in blue and Q in yellow featuring strongly, with a lower contribution initially anyway from Mount Magnet itself. The Eridanus project, especially the potential open pit, represents tangible upside to this plan, which I will come to. This plan delivers significant cash flows right now. With $1 billion of free cash flow in the first 3.5 years alone at a $3,000 gold price, approximately $200 million free cash in the first 2 quarters, I think is a testament to our ability to deliver on this. This mine plan contains a first pass underground option at Eridanus from FY26 forward, only some 270,000 ounces. We have materially upgraded the mineral resource estimate at Eridanus since then and are continuing to drill resource extensions. So in any case, it's likely that the underground option will be larger, but we're also looking closely at the open pit option, which when combined with a mill upgrade has the potential to keep production higher for longer at Mount Magnet, and that's also assuming we do not extend Penny and Q, and our track record of extending projects is excellent, and I'll point you to the Vivian mine as one of those examples. I've got 2 slides on Eridanus and the open pit option that we're obviously excited about. We have 1.2 million ounce resource at Eridanus, which was 64% higher than the previous resource. Probably more importantly, the grade went from 1.3 to 1.7, largely due to the identification of higher grade horizontal zones within the broader 80 metre wide granodiorite. These zones have not only been seen in drilling, but also were seen during the mining in the bottom reaches of the pit, where we were actually mining through 3 to 4 gram material in the lower reaches of that pit. The potential at Eridanus, the optimisation you see on the screen at 2,500 Aussie, produced almost a 600,000 ounce pit. I think it seems to be being forgotten by the market, but not by us. We have 2 diamond rigs, 1 on each end of the pit, drilling at the moment, and our underground versus open pit study will be completed by the end of the calendar year. And the guys won't like me saying this, but hopefully earlier. Perhaps the section doesn't do the size of this cutback at Eridanus justice, even though it is a 350 metre deep pit. But here you have a plan view of the same pit. On the bottom left, you see the current pit looking east, remembering that production from this initial pit will be around 300,000 ounces. The plan on the right, looking in a little more northerly direction, demonstrates the scale of the potential larger pit, with enough tonnes to feed the magnet mill for 6 years by itself. The potential at Mount Magnet to have a large open pit at Eridanus and a relatively large underground at Galaxy, which I'll come to, will simplify the operations at Mount Magnet, negating the need to jump from deposit to deposit, which has generally been the history. Here's Galaxy, with Saturn and Mars ore bodies on the left and the Hill 50, or the historic Hill 50 decline on the right. We've commenced stoping at Mars, and we're into development at Saturn. We've been able to widen the BIF resource at both Saturn and Mars, but particularly Saturn, on the back of recent drilling, where it's now larger than the 5-year mine design that you see on the screen. Galaxy has been a little bit of a slow burn, with decline rehab of the old Hill 50 decline and pumping of both pits, but momentum is now building and we're into commercial production with no more upfront capex. We believe that this mine will continue for much longer than 5 years, given the tremendous vertical continuity of the banded irons at Mount Magnet, no better demonstrated than the Hill 50 mine itself, which was mined, and there is a resource at 1.5 kilometres depth. Over to Q, we've commenced the pre-strip, as evidenced by the photo on the bottom left. Once we got mining approvals, we acquired Q via the takeover of Musgrave in October last year, and we were mining in June this year. We have an open pit reserve of almost 3 grams per tonne, which is healthy enough, but the sweet spot in the break a day load will come in quarter 3 FY25. So on the right, we have a long section of the Starlight lode. As you can see, starts very close to surface. It averaged 7 metres width in the top 50 metres, and virtually all grades are above 15 grams a tonne. As a result, we are gearing up the mill to deal with this very high-grade material, which has a very high gravity component between now and the end of the year in preparation. I've actually saved our best operation to last. Usually it's first, because I actually have a short video to show on Penny. Site visits at this time of the year, I have found, have been a bit hit and miss by virtue of having an unsealed gravel strip. Before I do, Penny produced at an all-in sustaining cost below $1,000 an ounce for FY24, but the best is yet to come. We're not even into the centre of the Penny North ore body, which is the one on the right. This will come in the second half of FY25, which will coincide with the commencement of development into Penny West, obviously underneath the historic Penny West pit. We have planned for exploration rig to head back to Penny in late August, with deeper extensional drilling in September and broader exploration drilling planned for November and December. I'll play the video. Music's a bit dramatic for this time of the morning, I know. But that shows you what we think of the Penny project. Over to the Rebecca Roe project. In June, we completed the infill drilling at Roe, infill and extensional programs. This long section shows the Bombora area, with the Bombora pit shell in the centre, and the underground loads where we were focusing on with our drilling, specifically the Chura loads on the left and the flat loads on the right. And our aim here is to convert relatively large areas of inferred resource to indicated resource. We have released a heap of results on Chura previously, which was drilled first obviously, and results will be coming in for the flat loads with the resource modelling being carried out concurrently. The second part of the drill program at Roe was a few kilometres to the north of Bombora at the Kopai area. Recent results shown on the plan on the right, with potential shallow oxide open pits likely there. In terms of the overall project, it's all starting to come together now after some drilling delays in the area due to the well-documented weather events earlier this year. We do have 1.4 million ounces at Rebecca and 1.7 million ounces at Roe. Largely shallow resource, obviously amenable to open pit mining predominantly. Our combined project PFS is now due in Q2 FY25. Finally, to our FY25 outlook. FY25 is expected to be similar to FY24, flagging another strong year for the company. The production mix will change somewhat though, with Mount Magnet up 50% to 240,000 ounces at the midpoint all-in sustaining cost of $1,400 an ounce. Whilst at Edna May we will run down the existing stockpiles, producing 45,000 ounces at an all-in sustaining cost of $2,600, remembering that this number includes approximately $500 an ounce of non-cash charges associated with running down those stockpiles. Therefore, cash generation at Edna May will still be healthy. We'll be putting Edna May on care and maintenance at the end of this process and not proceeding with stage 3 at this point, as we believe we can derive superior returns from other projects, specifically those at Mount Magnet. Pending the outcome of the Eridanus studies in H2, growth capital in H1 will mainly be associated with the startup of the Q project, and given that H1 capital will be only $25 million compared to the $50 million we spent on growth capital in FY24, we have a lot of confidence that FY25 will be another strong year for the company in terms of cash flow. Thank you for listening to the Ramelius story this morning.
Thank you, Mark. That was very comprehensive. There's a little bit of time, so there is an opportunity for a question. If there is any out there, raise your hand and we'll endeavour to pass that on to Mark. In the interim, Mark, I thought one interesting aspect that I'm interested in, Penny specifically, you said you're sending the drills back there. Is the opportunity to extend that, I guess, huge cash engine of your portfolio? Is it depth extensions, lateral, repeats? Where are the specific sort of targets for this financial year's drilling budget?
Thanks, Tim. Yeah, all of the above. Obviously, we'd like Penny to go forever. It's probably forgotten that we have added almost a year of production from what we initially purchased, about 70,000 ounces, and when they're super low cost, high margin, every ounce adds a lot of value, but the initial drills will be basically installed in the bottom of the mine, looking for those depths and plunge extensions. And then a little bit later in the year, we will actually have some surface rigs looking both to the north and the south more broadly, obviously hoping to find a bigger prize. But not forgetting that incremental ounces are important at a high margin project like Penny.